Hope everyone's doing well and had a good day. This is the Emini review for Tuesday, May 28th, 2024. And even though it's Tuesday, yesterday was a holiday, so the stock market was closed. We had a half day in the E-mini. And so I'll start with the weekly chart today. And you can see on the weekly chart, the market was in a tight bull channel since November 2023. And then we had this trend line break. So tight bull channel. Then trend line break here, but still above the moving average, and it's good for the bulls. But now we're retesting the highs. The bears are hoping we get a higher high double top, major trend reversal, and fall for a measured move, maybe down to here. And the bulls are hoping that the trend is weakening but not reversing, and maybe we continue in a channel like this, or maybe it's more broad like this. But either way, the bulls obviously hoping we continue higher. But I think that 3-bar sell-off on the weekly chart from the beginning of April was enough to convert the market into a trading range. It still might be a broad bull channel, but the trend has obviously weakened. And you look at this rally on the way up, these bars overlapping and completely within the 3-bar sell-off here. And as we try to break out, we stall and we get a doji. So as far as this week, I think if we do trade above last week's high, I think the odds are we'll find sellers above. But tight enough up for the bulls that if we go below, probably buyers below. You can see last week was a trading range, and obviously buyers below and sellers above is characteristic of trading range behavior. For the daily chart, you can see we're in a trading range here as well. So weak rally, lots of overlap, two-sided trading, then a bear leg. So we're above the moving average, we're below, we're back above, but going sideways again at new highs. Why are we stalling? Probably more likely a trading range. And if we are in a trading range, we know the gaps typically close. And we have a breakout gap here. And there are several breakout gaps. Maybe one here. Open gap here. And the point is there are open gaps below. So I do think we'll fall, but we may have to test higher before we do. You can see we had that big bear bar on the 23rd of May. And it's likely that that bar will get a second leg. But traders want to sell higher. We're in a trading range. And traders don't want to sell what might be the low of a trading range. They want to sell higher on a deeper pullback. So we may have to go higher before we find sellers. So for that reason, I thought if we did trade above the prior day's high, which was Friday, that we'd probably find sellers. But I didn't know if they would come in higher or directly above. And for the 5-minute chart, I like to draw yesterday's high and low before we get started. And I'll just label those as well. Okay, bar 1. So we gapped up, from the close of Friday, we gapped up into the open of today on bar 1. And bar 1 was a trading range bar with a bull body. And you can see it broke out above yesterday's high, and it looks like it closed about one tick above yesterday's high. So is that a strong breakout? No. The market only broke out by one tick, and there's a big tail above and below the bar. So there was a gap up, and you could argue this is a follow-through bar, but this is the first bar closing above yesterday's high, which is an important price. And the bulls really need more, and it would have been better if the bulls had a bar closing on or near its high. And so there's probably sellers above bar 1, but strong enough up that probably buyers below bar 1 as well. Then bar 2, we traded below bar 1. It was a bad low one short, and so there were traders buying below bar 1 for a scalp. But if you did buy below bar 1 and then bar 2 is your entry bar, you might not be willing to hold on to the trade for a swing. The first two bars have overlapped each other, and they have small bodies and big tails, and that's hinting toward trading range behavior. The first bar of the day is always important, and the open is always important as well, and it can tell you a lot about what the structure of the day will be like. Bar 2 is also a high 1 signal bar, and there are probably sellers above. In bar 3, there would have been sellers above bar 2, but when you're high in a trading range and you get a high 1, traders know that's a good trade, and it's almost greedy to set a limit order there and try to sell. And so what happened on bar 3? You had bulls who bought below bar 1, possibly disappointed with their entry bar on bar 2, and they may have scalped out and decided to bail out of the trade. You have bears who see we're probably not breaking out of this trading range right now, and we're high in the range, and it's a good price to enter short. And so traders sold the close of 2 and sold a little bit higher than the close of 2, but we could not get above the high of bar 2. And then bar 3 was a bear bar closing on its low. But the problem with bar 3 is that it's still overlapping bars 1 and 2. And the big tail below bar 2, there may have been buyers below bar 2. And it may have been leg 1 on bar 2, pullback, and then leg 2 on bar 3. It's still a gap up, and there are open gaps below. So the bar 79 high might be support, which is here. Instead, we fell further on bar 4, and that's good for the bears, so bear breakout, follow through. But you have to ask yourself, what are we breaking out of? So the pair of bear bars is decent, but the second bar was unable to close below the moving average. There's a fairly prominent tail below the low, on the low of bar 4, and the market is closing the gap, which was from the close of Friday to the open of today. Now the gap up, you can imagine as a bull trend bar, so big up, big down, big confusion, and just look to the left, you know we're in a trading range, and anything bearish, they buy. So that's the danger with looking to short here. Now this was strong enough down that the bears will probably get a second leg, but in trading ranges, traders want to sell high, not in the middle and not low. And so we may have to get a deeper pullback, and the second leg may be delayed. More follow through on bar 5, but minimum follow through. It's a trading range bar and an inside bar. That increases the chances that there are buyers below. But micro channel since bar 1, the odds are there are sellers above. Bar 6 broke further to the downside, but it's another trading range bar. But it's a high 1 in a micro channel, and again, probably more sellers above. But when you look at this, you know we're in a trading range, and we might be getting fairly low in the range. And that's the problem for bears. The equation is becoming bad. When you think about the trader's equation, and the hypothetical stop is above the spike. So here's a bear spike, and let's say you're short on the close of bar 6, stop above bar 2. What are the odds we get down to here before your stop is run up here? I don't know. It's not all that clear. Certainly not 60%. And because of that, you'll have more and more traders bail out of the trade because the equation's not good. It's a losing strategy to hold short here, hoping to get a measured move when you know the market's in a trading range and breakouts are going to fail. And it's more likely that when the market does something bearish, it'll be followed by something bullish. But again, bar 6 is a weak high 1, and there are probably sellers above. And this bear leg will probably get a second leg. Outside up on bar 7, I don't know if there was a report on bar 7, 10 o'clock Eastern time, but that's a common time for reports and easily could have been. It's good to be aware of that. So outside bar, but really just an expanding triangle on a smaller time frame. We fell below bar 6 and then reversed up and closed above bar 6, and that's good for the bulls. But the context, you're still going against a 6-bar micro channel, and the odds are there are sellers above. And again, it's an expanding triangle, so even though it's an outside bar, there's probably sellers above bar 7. Inside bar on bar 8, it's a bull bar closing on its high, but the context is bad. You have traders who might be selling a 50% pullback of the sell-off, and that would be basically the high of bar 7. And bar 8 is an inside bar and a small bar, and that lowers the probability of a breakout. And if we do get a breakout, it increases the chances that we'll pull back fairly soon. And you can see traders sold the close of bar 8, and we got a shaved bar on bar 9, so a bear bar with no tails above or below. But bar 9 is within the range of bar 7, so there's a lot of overlap here. You can see the past 5 or 6 bars have overlapped each other, and that is trading range behavior. So what do you do here? I think as a bull, better to look to buy lower, like below bar 7, or even lower. And if you're a bear, could this be the start of the second leg down? It could be, but I think bars 7 and 8 were strong enough for the bulls that pullback leg might be strong enough for its own second leg. So as far as selling here, I would not. I would look to sell higher. I think the location is bad for the bears, and I think this might be a pullback within a pullback. What I mean by that is we have a bear leg, the start of a pullback, and the pullback might grow. We might get a deeper pullback because it's a bear leg in a trading range. And so this is the start of the pullback. The pullback gets a pullback before rallying higher, and then we get the second leg down. So this is what might be happening. And then outside bar 10. So another outside bar, which is really just hinting that it's a trading range. Buying above 9 on a stop was a bad trade, and if you did take that trade, your entry bar is bar 10, and the close of bar 10 is really below your entry price, and that's not ideal if you were buying. At this point, we have 2 legs up after a bear leg, and we could get a second leg down here. For the bulls, I don't think it's ideal to be buying here. We may rally a little higher, but I think the odds are there are sellers above. You can see what happened on the open of the day. We tested the high of yesterday or Friday. By the way, whenever I say yesterday and it's Monday, or in this case Tuesday because of the holiday on Monday, when I say yesterday, I'm really referring to the prior trading day, which might be Friday. So you can see the test of Friday's high early in the day. There were sellers. The bull breakout failed. And if we get back there, there are bulls who are trapped above, buying maybe below bar 1, really buying anywhere up there. So if the market goes back up there, you have disappointed bulls who might be looking to exit a losing trade. And they might be scaling in lower down here. 11 was a trading range bar. And it's a doji buy reversal bar. Bad high 2. It is a micro double bottom, but the signal bar is weak. It's a doji with a lot of overlap. And again, I think the upside's limited. And even if we go higher, we'll probably find sellers above and probably get a second leg down for the bears. Probably sellers above, but they may not come in until maybe the bar one low. Plus, the odds that the high of bar one remains the high of the day is 20% on any given day. Right now it might be 30%, but the point is that the probability is low for that happening. And then an inside bar on bar 12. Bar 12 is the end of the first hour, so on the 60-minute chart we have a bear bar with a small tail above and a little bit of a bigger tail below, but it's a bear bar. So the bears controlled the first hour, as we can see here. Bar 12, we have an inside bar and probably sellers above. And then 13, traded above bar 12, and there were sellers above. Right now the market is in a tight trading range and a limit order market. And what that means is there are traders selling above bars and buying below bars. And it's okay to do that when you've had practice and experience, but for now, for me, I think it's usually better to wait when the market's in a tight trading range and wait for more clarity and wait for the breakout. When you look at this chart, you know it's confusing. We had a couple legs up for the bulls, leg down for the bears, all the bars overlapping, and the past 6 or 7 bars have just been a complete mess. They're all overlapping. They have big tails, small bodies, and the moving average is basically completely flat. And that's all a warning that the market is in a trading range and that it's better to buy low and sell high. What about the always in direction? I think it's a trading range. So if it starts to look bearish and always in short, you know you might be getting trapped into the wrong direction. So remember to buy low and sell high. Bear bar 14, it's a bear breakout bar, but obviously still within the tight trading range. Now, bar 14 could be the start of a second leg down for the bears. The bears are hoping maybe we get some sort of symmetrical second leg. We come down here, test the bar 67 low from Friday. And that would be a leg 2 measured move. But the bulls will buy below bar 7, betting that it's a trading range and that we will reverse up. And then 15 obviously did not go lower. It was a micro double bottom with 14, and 15 became a really strong bull trend bar. But again, the context here is really bad. It's possible that this is 3 pushes up for the bulls. And because of that, traders on a smaller time frame will be hesitant to buy here. Plus the bar closed within the tight trading range, and it's better if the bulls could have closed above the prior 10 or so bars. For now, 15, the bulls need to prove that they're getting the breakout. And for now, I see this as a buy vacuum, test of resistance in a tight trading range. And I think more likely there's sellers on the close of 15 or above 15 than buyers. And then instead we got follow through on bar 16. The bull's trying to break out of a wedge, but again, what are we testing over here? The bar 1 low. If you were a bull and you bought the low of bar 1, and then this is what the market gave you, the odds are if you get a retest, if you scaled in lower, or even if you didn't, this is like a gift if you have the chance to exit at break even. Plus the bulls, they say, or the bears say 1, 2, 3 legs up. Now this might have been strong enough for its own second leg, but the danger is that it could have been a second leg trap, and the odds of getting a second leg in this context in a trading range are lower. And then 17 was a bear reversal bar. So now we have a bear reversal bar, a decent sell signal bar, and the bears hoping we have a wedge bear flag. We had a bear breakout, maybe a 3 push pullback. Now we're getting a bear bar closing near its low. Decent stop order, but again, 15 and 16 were strong enough that it may get a second leg up. For the bulls, I think you have to get out of longs below bar 17. It's a second or third reversal down, possibly high in a trading range, and possible early high of the day here, maybe a lower high double top for the bears. Bar 18 was a bad entry bar for the bears, and for the bulls it's a high one, but we're high in a trading range. 15 and 16 were expected to get a second leg, but the second leg could be really minor, and it could be as small as 1 or 2 bars. Bar 18 could even qualify as the second leg. And if we do go above bar 17, I'm expecting sellers above. So as far as this high one, I would not buy. And then you can see what happened on bar 19. We did not trigger the stop order above 18, and instead traders sold the high of 18, and we sold off. 19, bear breakout, closing below the low of the past 3 bars, and closing below the moving average. Bar 19 is forcing traders to sell in the middle of a tight trading range here, but the momentum might be strong enough that it's okay to sell. The only thing with selling 19 is you need the trade to go your way quickly, and if it doesn't, traders will bail out of the trade. So some traders might sell the close or below bar 19 and give the market 20 or 30 seconds to plunge down. And if it does anything to hesitate, and some traders might give the entire bar 20 time to close, and if that bar close is disappointing, then they'll bail out. And then look at bar 20, it was disappointing. So bear breakout, but no follow through. There's a gap below the low of bar 18 and the high of bar 20. And if the market's in a trading range, we'll probably close that gap. But if the bears can keep that gap open, that's a sign of strength. The bears are still on the sell below bar 17, possible wedge, and what the bears want is a measured move down here. And this would test this support area over here to the left. Now, when you see bar 20, is that a tempting buy? Probably not. You could argue there's a bull trend line, maybe here, but it's a doji after a strong bear bar that will probably get a second leg, and it might be a nested second leg. You might have leg 1, complex pullback, and then leg 2. I think more likely there are sellers above bar 20. 21 closed the gap with the bar 18 low, but bar 21's a trend bar with bad context. Now, I said bar 18 was the second leg for bars 15 and 16, but the second leg may have started on bar 20 because markets are fractal, so we have a nested second leg on 18, but this all may have been one leg, and then we have a deeper pullback before a second leg. But here, even if 21 is a second leg up for the bulls, I still think the upside is limited. You might have had bulls trapped below 18 looking to exit on bar 21. And then 22 went sideways. So where are the bulls? If we're going higher, why are the bulls not buying? The bears, they would argue, we're getting lower highs. Market is contracting. The range is contracting. And it's a triangle, which is breakout mode. You know that when the market's in breakout mode, eventually it's going to break out. And we don't know the direction, but we do know that we have a failed breakout of yesterday's high. And we know that every time the bulls get anything, the bears sell. The bulls, how many times have the bulls had more than 2 bars consecutively today? They really haven't. And every time they've had 2 bars, they sell. So 2 bars up, they sold. 2 bars up, they sold. 2 bars up, they sold. That's a problem for the bulls. Now bar 22, for stop orders, it's a bad bar to buy above. Some traders will buy, betting that bears selling above will get trapped and we get the upside breakout. But those traders are similar to the traders selling below 19, where they'll give the market a little time to go, but we are in the middle of a tight trading range, And if it does anything to hesitate or pull back, they'll be quick to get out of the trade. With triangles, 50% chance the first breakout is in the wrong direction and then it reverses. Also with triangles, the apex of the triangle is typically a magnet because when you think about it, look what's happening here. Traders are in agreement that this is a fair price. We are in a tight trading range with bulls and bears buying and selling. So the odds are if we do break out away from this area, it will be a magnet later in the day or even maybe in a couple days. Bull breakout on bar 23, but really just breaking out of one bar. Maybe, the bar 21 high, 25 even, and the high 25 even. So it's breaking out of one bar. That's not enough for the bulls. It could be a nested second leg. We have leg 1, 21, pull back, leg 2, 23, plus leg 1, pull back, leg 2. The bulls trying to break out of this bear trend line. But the bears, they see a small bar like 23, which might be a second leg, and you can look at it as a second leg in a couple different ways. So bears will sell a bar like 23. And then 24, we have a doji. High 1 on a smaller time frame, and it's a micro channel since bar 20. But if you dissect the micro channel, let's look at it from bar 20 to 24. No bar traded below the low of the prior bar, but 3 out of 5 bars are dojis. One bar is, you can call it fairly big, but the reality is it's probably an average size bar, and this trend bar is small. And look to the left, it's a lower high. The reality is this is not a strong micro channel, and there are probably sellers above. And then outside down, 25. So the bulls trying to get the breakout on 25, and they gave up. And that may have been the first breakout attempt of the triangle, which has a 50% chance of reversing. And then 25 became an outside down bar. Now I've been saying that outside bars are trading range bars, and they are, but the context always matters. So you have a bull breakout that failed. Now the bears might get an attempt down. And I still think this leg for the bears has not had a second leg. You can argue this was the second leg, but you can also argue this was all one leg on a higher time frame, and then we pulled back for a couple legs before we get the second leg. The odds are the market will not stay in this range all day. And because of what's happening, I think it's more and more likely as we add more bars that we have seen the high of the day. By bar 18, there's an 80% chance we've seen the high or the low. And that number, 80%, gets bigger the more bars that get added. So at this point, I think it's more likely we've seen the high of the day. And it's one of those rare days where bar 1 remains the high of the day. We're getting several attempts up by the bulls, and they keep on failing. And eventually they will give up and look to buy lower. And the bears, they're getting stop order sell below 17, stop order sell below 25, plus this bear breakout. This has been the strongest characteristic of the day. Now it's not that strong. It is still a bear leg in a trading range, but I do think you can see this was stronger than the channel for the bulls. And when you get a bull channel, you have to think bear flag. So bear spike, and then a pullback, which is a bull channel, and bull channels become bear flags, and it's more likely we get breakouts to the downside. And that's the danger of buying below a bar like bar 25. I think 25 is one of those always in bars where if you're long, you have to respect it and get out of longs. And if you think it's still always in short since the spike on the open, 25 is a bar where you can enter short again. And then 26, we traded below 25 and got a disappointing entry bar for the bears. Market's still in a triangle, and the market is still in the apex of the triangle. And the market can remain sideways for a lot of bars. We're still holding on the horizontal moving average. But now 26 is maybe a high 2. You can call it a double bottom with bar 24 or 23. But the location is bad. The context is bad. Probably more sellers above. And then 27 triggered that stop order trade, but the entry bar has a big tail above. And if you did enter on a stop above 26, your entry bar closed at your entry price, and that's fairly disappointing. I keep talking about nested second legs, and I'm going to say it again. Leg 1 up here to 17, pull back, and then leg 2 here, and you can see the second leg subdivided into 2 smaller legs. Some traders might call it 3 legs. The point is, we're getting more and more selling pressure above, and traders are less willing to buy here. Probably sellers above 27, and maybe even disappointed bulls exiting on the close of 27. Sideways on 28, it's an inside bar, probably sellers above. What about selling below 28? It's a low probability trade, but context, some traders will take that trade, and again, they'll bail out if the market stalls or hesitates. But if they start getting the bear breakout, they will press their position and enter as the trade goes their way. Another inside bar, 29. So II pattern, inside. Whenever you get consecutive inside bars, what I think is interesting about that, this entire pattern, when you have a contracting range like this, you know that it's an II pattern on a higher time frame. And now we're getting an II pattern on the 5-minute, which is just a triangle on a smaller time frame. And so it's nested triangles. You have a triangle here and a bigger triangle here. So again, the market is in breakout mode. The range is getting extremely small, and eventually one side will get squeezed out, probably sellers above. And there are probably buyers below, but again, possible we've seen the high of the day, and this bear breakout still needs a second leg. Bull breakout, bar 30, but another doji. It's a weak bar, small body, big tails, probably sellers above. It's a weak breakout bar, and it didn't even close above the trend line. And then sellers above 31. Again, 31, similar to bar 25 and 17. If you're long, you need to get out of longs below 31, and okay stop order short below 31. Even though you're in a tight trading range, you know it's going to break out eventually. You know you're high in the trading range. The context supports a second leg down for the bears. And again, that second leg, 1 pullback 2, and it's nested 1 pullback 2. Now this second leg, look at all the tails and overlap in here. On some smaller time frame, that's a wedge. All these highs, that's 3 or 4 legs up. And then you have a bull breakout of a channel, which has a 25% chance of leading to higher prices. 75% chance it reverses down as it did here. Now this pattern is so minor that 31 broke out above that channel and then tested the trend line on the same bar. But just think it's fascinating. So okay to sell below 31. 32, weak entry bar for the bears, but you have to ask what 32 is for the bulls. It's a reversal bar, but it's a doji. And again, you're in the middle of a triangle. And I keep saying you can enter short, but I'm not saying you can enter long. And the reason for that is because of the context. When you measure where we are in the range of this overall trading range, we're in the higher, maybe upper third of the range. In general, here in the middle of the triangle, usually better to not enter on stop orders. And if you are entering on stop orders, you need to be quick to manage your trade. You have expectations when you're entering, trying to catch a breakout. And those expectations are the market is going my way quickly and trapping counter trend traders, which are limit order traders. So when bar 32 starts to stall, bears exit the trade. Now the same thing will happen in the opposite direction. Bulls will buy above 32, hoping to get the bull breakout to trap sellers above, because there are sellers above. But the problem is if it stalls and if the sellers are stronger than the buyers, we could turn down, get another outside bar, or get the bear breakout. 33, bull breakout, testing the high of yesterday once again. The problem with bar 33 is that it's possibly 3 legs up. You can call it 1, pullback, 2, pullback, 3. Now 33, one of the strongest bull bars all day. 15 might be the strongest bull bar, but 33 is a close second. Has no tails above or below. But the context is bad. You're high in a trading range, and you're at resistance. The bulls are getting the breakout of the triangle, but now they need follow-through. Remember, when either side needs follow-through, the other side knows that they need follow-through, and they'll do everything they can to prevent that follow-through. So you will have bears selling the close of 33, betting it's 3 legs up, high in a trading range. The bulls need follow-through, and if they don't get it, they'll bail out of the trade. Look at 34. Is that good follow-through? Of course not. 34 or 33 was a vacuum test of yesterday's high, and then everyone sold the close of 34. So bull breakout of the triangle, and it failed, and now possible bear breakout of the triangle on 34. Tail below 34, so it could be stronger, but really decent 2-bar reversal. And at this point, how many times have the bulls tried for a breakout and failed? At some point, they will give up and look to buy lower. Bad follow-through for the bears, 35. But for a bull, do you want to buy above 35 after seeing 34? Probably not. You have bulls who bought the close of 33. They got trapped on 34. They're hoping they get a second leg to avoid getting trapped. But right now the bears have an open gap between the 33 close and the high of 35. Probably sellers above. And possible scenario where the bulls get trapped and squeezed out. And then 36 continued down lower. It's a high one with a bear close, and that's a bad stop order trade. So probably sellers above. And it's important to realize you have bulls trapped on the close of 33, because now you have traders trapped and we're falling lower and lower. It's subtle, and the breakout doesn't look great for the bears because of the bull bar 35, the small bodies, the big tails, but it is a 4-bar micro channel, so there's probably sellers above 36. We're in the apex of the triangle, so it might be 50-50 here, but again, we have bulls that are trapped. 37, another high one. The micro channel continues, but it's another weak buy setup. I'm going to get rid of these lines as we know about the triangle. So the market obviously could just be in a tight trading range, and we find support below 26, find buyers, and then we rally up to above 33 or that area. That's what the bulls are hoping for, but 34 was strong enough that it'll probably get a second leg. And most breakouts pull back, and we have not had a pullback after the 34 breakout. And so these bars could be continuation of that breakout. On some higher time frame, this is all one bear trend bar. So again, probably sellers above. 38, a bull trend bar. But remember what I said about the traders on 33. There are probably disappointed bulls on 33 who will use any bounce to exit. If you did buy the close of 33 and then bought more above a bull bar closing above its midpoint, like bar 37, you might look to exit at your midpoint. And that would be here, close to the close of bar 38. So 38 is a good looking bull trend bar, but so is 33. And in both cases, the context is bad. You have bears knowing, some bears did not sell the close of 33. They missed this breakout. The odds are there are sellers above waiting for that second leg. And I'll always keep going back to this first leg here, which didn't get a symmetrical second leg. It's possible the bears get a symmetrical second leg starting from 34, taking us to a new low of the day and support from Friday. So some bears will sell the close of 38, betting the bulls are still trapped, looking to exit longs using a bar like 38. 39 was disappointing. It was a doji, so minimum follow through for the bulls, but breakout of what? 38 was a trend bar and broke out above the past 3 bars, but still within the range of 34. Possible deep pullback because we're in a trading range. So bear breakout, no one wants to sell low, everyone wants to sell high. That includes bulls and bears. 39, probably more sellers above, probably sellers at the close of 33. This 3-bar micro channel may have been enough for its own second leg, but as far as catching a second leg for the bulls here, I think it's dangerous, and eventually you may run out of second legs to catch. Outside down, 40. You can see we came close to the 33 close before reversing down. So bulls eager to get out of their longs when they were trapped here, bought lower. Now we're getting an outside bar, 40. It's a bigger breakout to the downside, even though the bar is weak. You know, if bulls did not exit their longs during 39, how are you feeling on 40? You might be feeling like you might be trapped. Bulls might get lucky. Maybe this rally gets a second leg, but there's real danger in holding for that. I think it's better for bulls to get out below bar 40. And then 41 was a second leg for the bulls. So leg 1, pull back. Leg 2, we rallied to about the close of 39 and then found sellers. Inside bar, so lowers the probability for a breakout, but good context for a bear breakout with bulls trapped above and possible head and shoulders, depending on how you look at it. Left shoulder, head, right shoulder. Double top with the high of the day. And it's a weak bull channel. And remember, bull channels are bear flags. So at some point, this channel can go on for quite some time, but at some point, the market will break out of it, and the probability is higher that it breaks out to the downside. So sellers above 41 and okay, stop order, sell below 41. And then 42. So what's interesting about 41 is not a good signal bar. And when you have a stop order that's not a good signal bar, you need your entry bar to make up for that bad signal bar. And then 42, that's a good entry bar. Because if a bull bought below bar 41 and this was their entry bar, they might be saying, forget this. If they had a stop and measure move down to the bar, they may be getting stopped out here. They may have already been stopped out. They may have already exited. The point is, if a bull bought below 41, 42 is one of the worst bars they could have gotten for their entry bar. Probably sellers above, and it might be sell to close. It crossed the moving average, still possibly in a tight trading range, but again, just like 19, you might have traders selling the close, selling below, trying to catch a breakout and momentum. And look what happened on 43. You can see we pulled back to the bar 41 low. So the low of bar 41 was 53.25 and 3/4, and the high 53.25 and a half. So it was one tick below the low of bar 41. So bulls are trapped. They got out. And they got out with a loss if they bought below bar 41. So you have trapped bulls, and this breakout is probably strong enough to get its own second leg. What about a possible second leg trap? It might be, but the market always tries to do things in a symmetrical way. So I think at a minimum, we're coming down to here. And that's close enough to over here where I'll just draw this line here. So this is about a symmetrical second leg drawn from here. And then you have the low of yesterday, which could also be a magnet, depending on how strong this breakout becomes. And then 44, terrible bar for the bears. You can see traders bought the close of 43, possible second leg trap, low in the range. The context is bad to be selling, again, with the trader's equation. If you're selling here, and you're going for 1-to-1, do you have a 60% chance of coming down here before up here? It's not very clear. We've had trading range price action all through here. And when the trader's equation gets bad, traders exit and look to sell higher. And then that's why we had a buy vacuum on 44. No one was willing to sell here. But at this point, what do the bulls have? The bulls might argue it's 2 legs down, maybe 2 big legs down, and a big bull bar, 44, but forcing you to buy right below the moving average and high in a trading range. And again with the trader's equation, is it clear that we're going for a measured move up to the high of yesterday or the high of Friday? It's not very clear. Market's more 50-50. And so we might have more sellers above 44. 45 minimum follow through, but bar 44, when you think about it, the only thing bar 44 broke out of that we can see on this time frame is the close of bar 43 because it's an inside bar. And the only non-breakout bars are inside bars. So 44 is a trend bar, but the fact that it was an inside bar is actually good for the bears. And then 45 broke out above 44, but it's a small bar, did not close above the high, could not break out above the moving average. And again, trapped bulls below 41, trying to get a chance to get out, but they still haven't got there. This might be strong enough for its own second leg, but keep in mind this is the more major pattern because you do have bears trapped on the close of 43, but you still have bulls trapped above here, and this will probably get a second leg. Bear breakout 45, but bad low 1 after a big bull bar and selling below a bull bar, so probably buyers below, and there were. But now 46 is a high 1, and the context is bad, probably sellers above. And then 47 could not go above 46, and instead broke out to the downside, but it was a weak breakout. The bar could not close below the low of bar 46, but the bears are keeping the price below the moving average, and this may be the start of a second leg down. Now the bulls still might get a small second leg, but that is probably the best case for the bulls here. And we're continuing lower on bar 48. The bears are hoping we get a measured move down of the double top. Here's the neckline. We get a measured move down to here. The bulls hoping we create a double bottom with bar 43 or bar 44 and then rally up to the high of the trading range. But for now, still trapped bulls above. And now we're getting a 4-bar bear micro channel, probably sellers above. Outside up 49, but still below the moving average. And this could just be the second leg for the bulls. I still think the bears will get a second leg. So I don't think this was the second leg for the bears. I think it's more markets are fractal. So this breakout all the way to bar 48 or 49 was all one leg on a higher time frame. And the market likes to do things in an orderly and symmetrical type of way. And so, is this a symmetrical second leg? Of course not. This leg is far bigger. So this might just be, what it really is a low 1 on a higher time frame. And you can see the low 1 here, 45, probably buyers below, and there were, but they didn't come in until down here, near the close of 43. Now we're getting an outside bar, but the reality is there are probably more sellers above, and this might be where the second leg down for the bears begins, because you still have trapped bulls above. And you have bears who haven't shorted yet. You have bears who didn't sell below 45. They haven't sold in here. Now they have an outside bar, which could be a second leg up for the bulls and a minor reversal, so probably sellers above. So 49 was a good looking bar for the bulls. It's an outside bar closing on its high, but the context is bad. It's a second leg at the moving average, and then the bulls got no follow through. It's a doji, but it's disappointing. Probably more sellers above. And again, the bears hoping for a double top, break below the neckline, measure move down. 51 triggered the low 2 below 50. Was not the best signal bar and was not the best entry bar. So it might be hard to get short or hold short. And that's the reality when you're in a trading range. The market's also in another triangle. We had a bear breakout, and then the market went sideways. But because we had a bear breakout going into this trading range, the odds are slightly higher we get a bear breakout coming out of it. 51, obviously not a good stop order buy, so sellers above, and might be sellers on the close. Disappointed bulls might look to exit. And then 52 might be sell the close. One problem with 52 is that this could be the second leg for the bears. And it depends on how you draw it, but could be leg 1, pull back, leg 2 to here. But this is strong enough down that it will probably get its own second leg. Now we're getting low in the day's range, but we still have this price over here, bar 67 low, which is probably a magnet. You can see there's a swing point in this trading range. And the market might want to see what's down here. And you can see we're falling quickly on 53, 3 consecutive bear bars. Decent breakout. You can see there's not much overlap. And that's good for the bears. And this was strong enough that some traders might argue it's 3 legs down. 1, pull back, 2, pull back, 3. And so you can call it a wedge. But whenever you have a wedge and you're hoping it's a wedge bottom, as it might be in a trading range, we're in a trading range, possible 3 legs down, double bottom with over here. The problem you have to ask yourself is, what's the buying pressure like? And all through here, the bulls have had some bars, but there are far more bear bars than bull bars. And every time there was a bull bar, it got bad follow through. So 4-bar micro channel, this bear breakout probably has sellers above, but because of the characteristic of the day, do I think it'll be the start of a huge bear trend? Probably not. Probably go lower, but these are sell climaxes, and eventually we'll find the bottom of the trading range. 54, an inside bar, profit taking by the bears. Bad stop order, so probably sellers above. It's an inside bar that lowers the probability for breakouts. Outside bar, 45, so we went below 54, and then 55 was outside up. Bull bar closing on its high, but remember, we just had a strong bear breakout, and there are open gaps, which gaps do close in trading ranges, but you had bulls trapped below buying here, and if they get a chance to exit here, they will take it. 56, another bull bar. So bull breakout, 55, follow through, 56, but no micro gap between 54 and 56. There is a negative gap or a body gap, but the tails overlap, and that's a sign of weakness. And again, the context is bad. You have this big sell-off followed by this smaller rally. What it might be is a 50% pullback. 50% is the same level as that gap, and you can see that's where we are. So it might be more sellers here. 57 went sideways. We went out a little higher, but sellers at the moving average. Sellers at prices above wherever bulls got trapped. Now traders don't want to sell 57. Now 57 might be a low 2. 54 was a low 1, and it was actually a decent scalp to buy below 54. But 57, you're now buying against 3 consecutive bull bars, and it's a doji. So there might be buyers below 57, but that is a more risky scalp to take. At this point, probably better to look for shorts, better to short above 57, but the bears might have to go more sideways before they come back in. And then 58, so if you did buy below 57, how do you feel about your entry bar? You might be in trouble. It's not the strongest bar in the world, but it's definitely not what you wanted if you're buying below 57. If you're buying below a bar, your ideal entry bar is a bar like 55. So this low 1, buyers below, great entry bar, they scalp out. 57, bulls buy below, and then they get 58. There's an increased chance that traders sell the close of 58, bailing out of a bad limit order trade. If we do go above 58, it's a bad stop order, high 1, probably more sellers above. And you can see what happened on 59. Instead, everybody bailed out and everyone sold the close of 58. Testing these prices, the bulls are hoping that we get a double bottom, but ask yourself about the buying pressure in here. Small tail here, but as far as the close of 58, there was not much overlap with bar 59. We're probably going at least a little lower. Ideally, for the bears, they're looking for that double top breakout of the neckline. We come down here. And I'll draw that one. I'll make this one a different color. So this would be this bear flag measured move down. More selling, 60, might be sell to close, completely below the moving average. It's another strong bear breakout. But again, the way the day structure was, a lot of trading range price action, might be 3 pushes down. And that's the problem for selling here. Leg 3s have a much higher probability of getting deeper pullbacks before they get continuation, if any. But strong enough down, I would not advise buying here. And then 61 dumped to the measured move that we just drew. So here's that double top, break of the neckline, and then that's where this bar raced to. And at this point, you have to be wondering if we're going to test the low of Friday. Strong enough breakout, it'll probably get a second leg, but becoming climactic. It's a parabolic wedge, and parabolic wedges get minor reversals. They're breakouts on higher time frames, but because of the context, whether you look at whatever higher time frame you look at, you know the market's in a trading range, and this might be a sell vacuum test of support before we get a reversal up. Similar to what happened here, 33, buy climax and then immediate sell off, or sell climax and then immediate rally. This happens on higher time frames as well. Now we're getting consecutive sell climaxes. We could rally, but again, that does not mean I advise buying the close of a bar like 61. 62 going lower. Micro channel since 57, the odds are we'll find sellers above in a second leg. 63, traded above the prior bar, the first bar to do so since 57. Low 1 below 63, probably buyers below. And then look what happened on 64. Those low 1s are so common. So bulls buy below 64, bears exit shorts below 63 on 64, and we get the bull bar 64. But do you really want to buy above 64? Probably not. It's a minor reversal. Another bull reversal bar 65, but still not a good buy for the bulls. The context is bad. You have a tight micro channel, and then you have trading range bars. The odds are there are sellers above, and the bears will get a second leg. And then instead we got a bull breakout 66. And so we had 3 consecutive bull bars And the market was far from the moving average. And when you ask yourself what kind of day this is, you know it's not a bear trend day. When you get these sell climaxes are actually a problem for the bears. So the bears are making money, but it's not controlled. The bears are controlling price, but they're not controlling time. What I mean by that is they get a couple bars down and then we go sideways, a few bars down, sideways. This was obviously bigger, but what does Al say about getting strong legs late in a trend? If this is a bear trend, you know we're about 20 or 30 bars into it, and now all of a sudden we're getting the strongest breakout on a leg 3. You have to wonder if that's suspicious. And then when you're far from the moving average, getting trading range price action like that, the market can get vacuumed up to the moving average quickly as it did here. So 66 bull trend bar, but probably sellers above. Bears will probably get a second leg down. You can argue that 64 was a second leg down for the bears, and it was. It was basically the absolute bare minimum. We sold off down to 62, pulled back to the high of 63. On some smaller time frame, there was a bear bar or consecutive bear bars here that was a second leg testing the low close before we rallied. But I still think probably sellers above. Bulls trapped here. Maybe they'll sell here below. Buying below 53, they were trapped. And at the moving average, they were trapped up here or here. And then look what happened on 67. 67, hard to sell that bar. It's a low 1 after 4 consecutive bull bars and a strong bar on 66. So there might be more buyers below, but I think the upside here is limited. And the market might be in a trading range. We might have to come back down and test here. Now we had consecutive sell climaxes, a bull trend line break. This is a minor reversal. And what's expected after a minor reversal, what the bulls really want is a weak retest of the lows and then in some sort of double bottom, whether it's a lower low or a higher low, double bottom, and then a major trend reversal back up to the high of the range. We came so close to the low Friday, we may have to come there. Again, this is a minor reversal. Even though it's big enough to break the trend line, it's not enough to undo all of this. Bull bar 68, but possible second leg up. Could even be 3. 1, pull back, 2, pull back, 3. Or just 1, pause, 2. So bull trend bar, but just barely closing above the moving average. The bulls need more. We're at this breakout point where bulls were trapped and they may look to exit longs. And that's what's happening on 69. For the bears, this is tight enough up that we may only get halfway down. We may not get to the low of yesterday. And I think that would be an important price to look for. Because that rally was surprising. Bar 66 was surprising. This bear sell-off should have had a second leg. And so far, we don't have one. We can basically call it that. The bar 63 high is roughly 50% of this rally. So even if we get here, you have bears who are short down here, disappointed by the rally. They might look to get out with anything they can get. Bar 70 went below 69, but reversed up, found buyers. If you're a bear, you can see the market's going sideways here. We've had this bull breakout. Now we're going sideways. The bears are hoping we get here at a minimum, but that does not mean we will. And the bulls are hoping they can prevent the market from coming here and that the bears get squeezed out. And then we're going higher on 71. And now the bears are wondering. Well, it depends. So you might have bears selling here. They're selling momentum, not necessarily thinking that it's a bear trend, or they're thinking it's a bear trend. But when you have consecutive sell climaxes, a parabolic wedge, and you've had a trading range day all day, you have to wonder if this was just a sell vacuum test of support and whether the market can basically do the opposite fairly quickly. Coming into the last few bars of the day, we're in bar 71 here. And there are 81 bars of the day session of the Emini. So the final 10 bars, the market can do something drastic to influence the way the daily chart bar looks. And for that reason, it's near the high of yesterday, but I'll also draw the open of the day, because on trading range days, the open of the day is important. We are far from it here, but when you've had 3 consecutive sell climaxes and then a bull surprise, surprises get second legs. And if the bears can't get here, and then we start getting higher and higher, they may look to bail out of their shorts and just give up on the trade. Bear bar 72, so the bulls tried to get the bull breakout. They failed. Some traders might see it as an expanding triangle, but again, it's breakout mode, and we're getting a couple legs up, maybe 1, 2, 3 legs up for the bulls. The bears try for the downside breakout, trying to get to the low of Friday, but I think they'll have a hard time getting below this price, the 50% pullback of the rally, the high of 63, if they even get there at all. And then 73 is a problem for the bears. They could not trigger the stop order below 72. And then 73 is a bull bar, completely reversing 72. This is a wedge, but you have to wonder about the selling pressure in the wedge. So 1, 2, 3. But bear bars have big tails and small bodies. There are more bull bars than bear bars. 74, another stop order sell for the bears, a signal bar, but it's a doji. And again, there's not much selling pressure. And now we have an open gap from the open of 72 to the low of 74. 75 closes that gap, and that's good for the bears. Now the bulls are controlling bars completely above the moving average. So 73 broke out above the moving average. And the following 2 bars are bear bars, but they're both completely above the moving average. And that's a problem for the bears. 76, another bear bar, but overlapping the prior bar. So it could be leg 1, pause, leg 2, pause, leg 3. And you have bears trapped on 72, front running the sell that never triggered, so they're trapped here. Plus you have bears who might be trapped down here, especially trapped on 66. If a bear sold above 63, they were trapped, and 66 was a surprise, expected to get a second leg. Was this a second leg? It could have been. It's a spike in channel. We know that spike in channels, with the market cycle, channels evolve into trading ranges, and the market could easily test the bottom of the channel, which would complete the trading range, complete the market cycle. And that would be roughly the low of any of these bars, 67 or bar 70. But even if we do get there, I think the best case for the bears here is the trading range, and there's an increased risk that we get the bull breakout late in the day. And then 77, bull bar closing on its high. Still within the range here, but again, you have to ask about the selling pressure. So it's a wedge, but it's not a wedge. The problem with the wedge for the bears is the lack of selling pressure. Every time there's a bear bar, the bulls buy it. And then they get 3 consecutive bars here, but they're almost all completely above the moving average and within this bull breakout. So bull breakout, pullback, and then another bull breakout. And then you see a bar like 77. And then traders start to wonder, first of all, do you really want to sell the close of 77? Probably not. You know, it's a strong enough bar, we're probably going higher. And we have a trading range here, and look where that measured move takes you, straight to the open of the day. As crazy as it sounds, price can vacuum up to that magnet. And then you can see 78 rallied fairly far, probably going a measured move of 77, so you will have traders taking profits on 78. Plus we're getting so late in the day, not really worth doing much of anything here. And then look where 79 went. We tested the high of Friday once again, we tested the open of the day. At this point, the bears are trying to just make sure the daily chart closes below the open. But even if it does, the bulls put a respectable tail below the open of the bar. So big tail below, the market's all the way back up here. And then just two small bars into the close there. Here's the daily chart. So here's the bar on the daily chart. You can see the market sold off. And then in the final couple hours, the bulls rallied fairly strongly. For always in today, it might have been always in short on bar 4, but the context was bad. You're in the middle of a trading range. The bars are still above the moving average. So at that point, I don't know, probably more trading range price action, buy low, sell high. And I can say that for the majority of the day. I was saying that on bars like 17, should probably respect it as an always in short flip, but we never really got it. Same with 25, same with 31. These are bars that bears will sell below on stops, hoping to get the bear breakout. And if you're long, bulls probably need to exit longs below those bars. But the market never really flipped, and we're in a tight trading range all through here. So probably just buy low, sell high. Then you get consecutive bear bars, one closing well below the moving average, probably always in short 43. And then you get 44. So every time you get always in a trading range, you know it's opposite day. You know that when it flips to always in short, you probably should not be shorting. And that's why I like to say buy low, sell high in trading ranges. In this trading range, where are we? High or low? Obviously, we're low in the range. And then here, never clearly always in long. Here, probably always in short again. This time the bear's able to control several bars below the moving average. So probably always in short here, and then definitely here. But proceed with caution because it's a trading range day, and these are sell climaxes, and these are not as strong bear breakouts as they could be. Always in short through here, but then you get the low one, probably want to get out of shorts below 63. And then always in long 66. Context wasn't great. You're still completely below the moving average, but it is a trading range day, and it could be an end of day reversal. And then did it ever flip to always in short? I don't think so. I think it's okay to hold long. Stop orders on a day like this are really tough because for a lot of the day, the range was tight, in a tight trading range. So as far as stop orders, I don't know. I thought the best one to start was probably selling below bar 17, but it really wasn't ideal after those bull bars. And then after that, maybe 25, but obviously, again, not ideal selling at the moving average in a tight trading range. Probably sellers below 31, but small signal bar, and those typically get run. So if you do sell below 31, it might be wise to use a wide stop and scale in higher. 2-bar reversal 34, so you will have traders selling below 34. And then that outside bar 40, probably sellers below there. 51 was a low 2 at the moving average, with bars below the moving average, probably sellers below. Might be sell to close 52, 53. And then 57, hard to take it after 3 bull bars. You can call it a low 2, low 1, 54, low 2, 57. But difficult stop order trades to take today. Might be sell to close in here, 59, 60, 61. And then you get the pullback. And then, I don't know, really aggressive to buy above bar 65. And then through here, again, really hard to take stop order trades anywhere in here today. For limit orders today, I mean, there were pretty much limit orders all over the place. These are the days where limit order traders do well when they know what they're doing. You have traders buying below every bar and selling above every bar. Even if a trader bought below bar 1 today and scaled in lower, look where we tested on bar 17, right to that price. Tight enough down, probably need a little more before buying below here, but then you get that pullback, and then bar 10 or bar 8 becomes a low one short, but 2 bull bars, buyers below, and then all through here, of course, sellers above bars, buyers below, and that goes for really all of this. Through here, I wouldn't be looking to buy below. Probably better to look to sell higher on some sort of pullback, like a breakout gap or 50% pullback. And then through here, I mentioned the bar 63, low one, was a pretty good limit order buy for a scalp. 66 was a surprise. And then after that surprise, you're expecting buyers below a breakout, so probably buyers below any of these bars, and they came on bar 70. And I mentioned this was a bad wedge because the selling pressure was weak in the day structure, and you're just selling below a bar at the moving average, so probably buyers below here, 74. If anyone has any questions, and especially if they are related to the video, please leave them in the comments with the timestamp, and I'll get back to you as soon as possible. Thank you for watching. Hope everyone has a good rest of their night.